Welcome, everybody, to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way to exit highly appreciated multifamily properties, cryptocurrency, businesses, defer the capital gains tax so you can create and preserve more wealth, or help your clients, friends, and family do the same, and/or raise capital and unlock capital to go into your deals that are otherwise locked up because of the capital gains tax. My name is Brett Sorch, and each and every episode, I'm joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple, and passive income plans achievable. I'm excited about our next guest. He's out of the great state of Wisconsin. And he's an established real estate investor and operator specializing in multifamily, commercial, and self-storage facilities. With a real estate career spanning over 15 years, he has garnered extensive experience in building and rehabbing single-family duplex properties and laying the foundation for a successful journey in the real estate industry, and so much more. Please welcome to the show with me, Mr. Jeremy LeMere. Jeremy, how are we doing?
I'm doing well. Thanks for having me.
And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Sure. So I started in real estate really when I was a kid, I guess you could say. My parents had some duplexes and things like that as a kind of a mom and pop operator, just probably about 4 or 5 properties. Got to work in that area, taking care of the lawn and doing other things when I was a kid, but then kind of got away from it from kind of high school all the way on, went off to college and did my professional career. And then in 2010, I got back into real estate and looked at it from a recession standpoint that we had in 2009 and as a substantial opportunity to get discounted properties. So we actually started shifting our assets out of the stock market and bringing them into REO properties. A lot of fix and flip type stuff started out early. And then eventually we migrated into larger stuff, multifamily, and eventually self-storage and other things.
Fantastic. I love that background. And before we dive into our topic at hand, which is Wisconsin multifamily investing, I do want to take one other step back. I believe we've all been given certain gifts, Jeremy, in this life, and these gifts have been given to us to be a blessing and help to others. I'm curious, what we feel like is your one superpower or gift that you were given, and how does it help how you help and bless people today?
Yeah, so for me, it's really about operations and detail. I really strive to have everything, I'll call it exact. I'm not an accountant, but I have an engineering background from a degree standpoint. So I really fit into that tightly knit operations activity and looking to streamline things and make things operate as best they can and bring profits to the bottom line is what I ultimately was chartered to do over my career.
Awesome. I think that's so important. Operations so key. And we're going to talk a little bit about, building a team within multifamily investing as well during this talk. But let's dive right into the topic, which is Wisconsin multifamily investing. So what is the number one secret, Jeremy, to investing and making and building wealth within multifamily, especially for where you're specializing in the Wisconsin area?
Yeah, for our area, I think the most important thing is that you buy a solid asset that is in a good neighborhood. In general, our markets are really stable overall. So if you can get an asset that is anywhere in that good neighborhood of the C class and on up, you're going to be situated in really good shape. Occupancy tends to be really good. We have very, very low kind of construction activity compared to, overcapacity in some markets where we're building hundreds and hundreds of units at a time in a complex. We tend to be a lot smaller because many of our markets are a lot smaller. And as a result, the occupancy rates really stay, in that mid 90s or better. For a long time, we were sitting in the upper 90s, especially if you sharpen the pencil and you actually operated very efficiently. Many, many, many months, we can operate 97+%.
Okay, excellent. So the right location, the right property, right? And then making sure you have, you're having high occupancies, right? You're keeping those going. What is it about that area? I mean, you're local to it. I mean, maybe that is more the secret. You're local to it. But it seems like they're a little more steady. Those markets are a little bit more steady. Talk about just the consistency of that market versus some of the other markets that people invest in.
Yeah, I do coaching on a national basis, so I see differences that happen all over the country, especially in some of the larger metropolitan areas where, uh, you know, like I mentioned, very very large blocks of units come online, and it's tough in some cases for the market to absorb all of those units, and as a result everyone kind of takes a dip and settles into a new normal, and then they slowly work off that, as potential recessions, like we're going in right now, where we're going to see a substantial reduction in new building permits, and it's going to drop off, and eventually the market will absorb that. We tend to build with fewer units in most of our complexes that are being built. And as a result, the absorption tends to happen a little bit faster. And also, just we tend to have less need for brand new assets, from the standpoint of we don't have a substantial influx of population coming into our areas. We have regional migration that happens from some of the rural areas, which keeps the market steady, but we don't get that large influx that really draws that excess construction and activity that people try to get into based on the statistics of a market.
Yeah, I could agree with you more. And by the way, you can learn more about Jeremy LeMere by going to starcmg.com, starcmg.com. I grew up in Sacramento, and we always said it was the place with really no real border to growth, meaning it was you can go out every which area and it just keeps growing, right? And so you're right, they get absorbed and the developers would come in and build thousands of units. And Sacramento was kind of like the secondary type of city, still a city, it's the capital, but you have San Francisco that, you have all of the ocean, and then you have, LA it has the ocean too, San Diego, bigger markets. But Sacramento is kind of that mid market where it had to always play catch up. There was one place called Davis, and Davis basically created like a zone where we're not going to build outside of that. They have great schools, and they've seen even more rapid appreciation and more stability. Why do you think they're not building as much or overbuilding as much in a place like Wisconsin? What is the natural barriers to entry versus more people, just developers building more units?
I think fundamentally it's the lack of attention on our market. So that is the first and foremost, the blockage of folks coming into our market to build at that level. So organically, our apartments are built locally, if you will. The investor base tends to be very local. There's a couple key players in many of our markets that build most of that, and they're very local. To your point, they have built their entire portfolio within the region, and as a result, they just grow it based on what they see as the demand. And frankly, in many cases, the opportune time to do that construction. So probably about 5 years ago, we were kind of just hitting the sweet spot in the upcycle where construction costs were still really low. And as a result, those that were kind of in a good position and knew that their occupancies were high started building additional sites or facilities, and brought those online just in time for the demand that really happened in 2020 to 2022. Really hit that with low cost construction, and brought it online when people were kind of really expanding out in a household sense. So they had really good timing in the market, and kept everybody else outside of the, from coming in from outside the area. Most folks in the local market really can't come into the space because of the capital costs. We don't have a significant number of folks that can support, the millions of dollars that are going to be necessary in order to do that construction. So those folks kind of continue that process, year after year, and frankly, decade after decade for some of them.
Yeah, really interesting. Again, we're talking with Jeremy LeMere. You can find more about Jeremy by going to starcmg.com, starcmg.com. So talk to me about value right now, Jeremy, right? And finding deals that make sense. Like we just both got back from Dealmaker Live, right? With Michael Blanc, amazing, coach, syndicator, operator himself, all of the things. Like talk about where and how to get deals done today when interest rates are pretty, high relatively to what they were before, and cap rates are still not. I mean, they are getting higher, but still, I feel like it's just like a negative arbitrage situation for a lot of deals, and a lot of the rents have been, raised, and a lot more people are in the business because they had a big run up. I don't know. I just feel, and people are probably getting out because they're getting caught on these rate caps. So just give me your sense of the market and maybe any live deals that you're working on. You're like, wow, I'm really excited because of X.
Yeah, absolutely. I think the most important thing is if you're really close to the market, you can still work out, I'll call it work out deals with owners that are in the market. We've been closing still a couple deals. We just closed one at the end of 2022. It would have seemed that it would have been crazy to close that deal with interest rates where they were climbing, but we were still able to get that deal done. We're operating it. We have to operate effectively, more so than if we would have had a better position, if you will, from an interest rate or better pricing on the property. But we can still operate it. We just have to keep our I's dotted and T's crossed as we go forward over time, and make sure that we're managing spending and capital improvements and such in a way that allows us to continue to operate. But most of the deals, I shouldn't say most of the deals, many of the deals, when they come up or in transaction process, many of them are closer connected individuals making those deals happen. There's kind of inner investor sales that are going on when one person wants to exit the asset. They have a network. So for me, it's been very key over the last 3-4 years, while the prices were substantially higher than what they had been, to really be connected with a network of folks that are, changing their strategy in their real estate investing. They may be divesting of smaller assets, and looking to go into something larger, exchanges or whatever it may be. Those properties are going to go quickly, and they may not even be seen in the from a brokerage standpoint. So you do want to be connected in order to make those things happen.
Yeah, makes sense. I'm curious. Let's talk about raising capital, right? It seems like that's the holy grail these days. I mean, it's always really important, but it was definitely, I think, less challenging. Let's say 2-3 years ago, right? More and more, a lot of people wanted to get into the deals where capital was perhaps easier flowing. Now it's harder, right? Because things are changing and there's uncertainty. There's, people are pulling back. Loan to value ratios are going higher because interest rates are higher, right? So debt coverage ratios aren't as favorable. So banks are pulling back a bit. So you have to have a larger down payment to do deals. So raising capital to me is number one, right? So what would it mean, Jeremy, if you could 1031, let's say someone has Bitcoin, you could kind of like 1031 Bitcoin into syndications or funds, all tax deferred, right? So you could pull capital from places that otherwise would be hit with a huge tax, and you can solve a problem that brings the capital into your deals. What would that mean for an operator and a multifamily investor like yourself?
Yes, that raising capital is the key to this industry. If you're at the point in your career where either you've deployed all of your own personal capital and you're continuing to grow, you need to be able to raise capital, if for no other reason, to help diversify your portfolio so that you're not all in one place, right? If you have limited capital, you want to be able to spread it across a couple investments. So bringing outside capital in is huge, and I think the most important part of that raising of capital now is some of that creative structure of how do you bring it in ways. There's lots of different things that you can do to tie other folks from a structural standpoint in that deal, from an operating agreement, whether it's some joint tenancies and that sort of thing. You can bring some of those folks in and close that capital gap that you have to achieve. From a raising standpoint, I think the most important thing is that you're properly underwriting a deal so that you realize what the returns need to be in order to raise the capital, because the numbers are a bit different today, right? We have a different perspective on the risk associated in multifamily or many other asset classes right now from a commercial real estate standpoint. So you really do want to make sure that you're underwriting in a way that you know that your investors will come to you for your rate of return versus the risk in the deal that you're doing. And then, ultimately you have to deliver on the results, and that credibility will really take you a long way in ensuring that what you're underwriting will mean something in the open market.
Got it. And for people who are wondering, and Jeremy, thank you for saying that. Yeah, he was referring to like a tenant in common or carve out where you can 1031 exchange investment real estate into individual syndications. That is possible, and it can work out if all the things line up. What I was referring to, Jeremy, is taking like something that's not like kind, right? Like it could be a business sale, it could be cryptocurrency, it could be a primary home, right? It's not investment real estate, it could be stock. And exiting a lot of these assets that are highly appreciated, and people getting into real estate when the values actually are coming down. There's some more opportunity now. Now it's a great time to be buying multifamily because a lot of people are getting out, right? And prices have softened a bit, right? So that's what I was referring to. And by the way, we can do that. It's called a deferred sales trust. If anyone's wondering, you can exit cryptocurrency tax deferred and diversify it into multifamily syndications, into your own multifamily deal, into other commercial real estate assets, into the stock market, into business ventures. And you don't have to be highly concentrated in that Bitcoin, that Ethereum, that NFT. You can now diversify and buy real estate. And we think it's a perfect time to do that. If you want to learn more about that, go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Jeremy, any thoughts on that?
No, I think that's great. Anytime you can migrate funds from one asset class and rebalance, if you will, with the spikes that can happen from time to time in commercial real estate, you want to balance back out of it. In points where real estate may be down, you may want to re-diversify and redeploy capital from other asset classes, just as you were describing.
Yeah, excellent. That being said, Mr. Jeremy, we're running out of time. Are you ready for the lightning round?
Sure, absolutely.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget and make sure to tell yourself to do?
Start in real estate a lot earlier. The long game is key on real estate, and miss the opportunity at the fear of the scale of it.
Excellent. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
I would say oh my gosh, I've been reading quite a few, but my biggest focus has been on efficiency and that sort of thing, and how to kind of get my time back. So the 10-hour work week has really strung an accord with me.
Excellent. 10-hour work week. I'm gonna write that one down and get that one going. Next question. What are you most curious about?
I am the most curious about how our national debt is ultimately going to play out relative to real estate and inflation. We're kind of hedged in hard assets, real assets, and I'm looking forward to seeing where that goes.
Yeah, it's kind of scary, right? And it's been scary for a lot of years, but I feel like it doesn't change, and that's the frustrating part. But I'm with you. Hard assets, especially multifamily, value add. I love mobile home parks, RV resort. Those things are like, to me, one of the safest places to invest. Okay. Question number 4. Number one leadership quote or theme that you strive to live by?
I don't know that I can quote any directly, but for me, it's honesty and integrity. I mean, my foundation of everything I do, the folks that I interact with, from a business standpoint, my investors that I work with, when things aren't going good, you still communicate. Those are the most important things.
Excellent. Next question. Number one way you use Chat GPT?
Yeah, it's actually a very quick way for me. We're using it in we do property management. So we write a lot of letters, that may be one-offs for something, and what the content needs to be from a bullet point standpoint. So we use a lot of Chat GPT to generate quick letters and then just do minor adjustments to them and get them back out to folks in probably 1/10 the time that we used to have to kind of write unique one-off letters.
I think that's so smart, Jeremy. Last question. After all your success, helping all the people you've helped, doing everything you've done, how do you best stay centered in your values, and how do you stay encouraged to charge forward to reach even higher heights?
My success is centered on those core values, and I've just held them. I've even had challenges in my professional career where folks are skirting some of the situations, and I've just always stuck true to my person and my integrity and my to do the right thing. It's always been a win long term. There may be some knocks short term where somebody jumped out ahead of you by doing something with less integrity, but it has always led me to consistent success and wins. So I stay there.
Fantastic. Hey, Jeremy and LeMere, I want to thank you for being on the show, sharing a lot of wisdom with us today. I want to encourage you to keep using the gifts of being detailed in operations, getting things done, also having a heart for serving and helping others do the same. For our listeners who want to get in touch with you, would you mind, and one last time, what's the best place for them to find you?
Sure. You can go online to starcmg.com. That's Star Capital Management, starcmg.com. And you can always reach out to me at jeremy@lemere.com also.
Fantastic. And I want to thank our listeners for listening to the episode of the Capital Gains Tax Solutions podcast. By the way, we're also streaming on a couple others as well. We have the Build It to Billions podcast that's actually releasing soon. This is kind of a sneak peek of some of the episodes going to be on the show, as well as the Expert CRE Secrets podcast, which is pretty cool. And I want to encourage you to take action today to start investing into things that are, or continue to invest into things that are hard assets that are going to stand the test of time, given inflation, stuff like multifamily properties. Also have a plan, right? We believe most high net worth individuals and those who help them, they struggle with clarifying ways to bring in capital from different areas, tax deferred, so they can fund their deals, and or you might be wanting to sell to diversify your assets. You want to check out the Deferred Sales Trust. Go to capitalgainstaxsolutions.com to learn more about how that works and how it can help you unlock freedom and make a bigger impact. You can also check out the book we wrote, Building a Capital Gains Tax Exit Plan. We break down the 1031 exchange, the Delaware Statutory Trust, the Deferred Sales Trust, and basically our journey to freedom and impact with the Deferred Sales Trust. Pretty cool. Check that out, Building a Capital Gains Tax Exit Plan on Amazon. That being said, we appreciate everyone watching today or listening. Please rate, review, subscribe, share it with someone who can make an impact today, and we'll talk to you